What we're going to talk about today, it's going to be exciting and fun. I got a lot of stuff planned for you, and I'm going to show you some live trades as well. If anyone's watching the market, as you should be, more than likely you're seeing SP 500 getting a little bit bearish here. We just took out some of the lows, and we failed to take out the low and trade below the 55 today. So I'll show you some real-time examples with this stuff and how to apply it. I think when you're listening to anybody give you education, it's also important to see it applied in a today market. I mean, it's easy to show you a chart of the last couple of days of where I would have bought, but it's more important to know where would you buy, where it's all in real time. That's our job as traders. So I want to remind you guys the information of this presentation is for educational purposes. It's not constitute investment advice. The risk of trading in securities markets can be substantial. Past performance not indicative of future results. So now that we made the lawyers happy, I want to do a little exercise with you guys here, with everyone in the room. So I see there's quite a good attendance, so this should work pretty well. Before I tell you about myself, I always like to do a little bit of an exercise and to sort of demonstrate this concept to you. So if you guys play along with this, it'll be a good learning opportunity. If you don't, it'll still be a good learning opportunity. All right, so I want you guys to take a moment and look around your room, wherever you might be sitting, your office. If you're in your car, don't look around too much. Keep your eyes on the road. I'm not responsible for your driving habits. But take a second and notice everything around your room that's green. All right, so just look around. All right, just give it a second. Look around, notice everything that's green in color. All right, now close your eyes for a moment and answer this question. What in your room is the color red? It's a bit of a trick question. So if you had a hard time recalling something that's the color red, that's because that's how your subconscious mind is primed to work. Your subconscious mind understands and accepts information that you train it to seek. And as traders, you could open your eyes now, by the way. You might want to see the rest of the presentation. As traders, we're trained to see information that we want to see. So we want to know when should we get in. We're focused so much about the when moment of trading that when it actually happens, we don't really have the skill set to execute it. So a lot of execution is a lot of the business. So as a trader, you could be trained as much as you want. You could be doing technical analysis till the cows come home and you have a level. But when it's time to press the trigger, will you do it? And that's really what we focus on at TRADEPRO Academy. We take the education and we put it into an execution-based method. We get you to click the trigger, because somebody who does technical analysis is an analyst, but not yet a trader. Somebody who does a trade actually then becomes the trader. So the whole point of this exercise is to be successful as a trader. The information's out there. It's available to you. You just have to train yourself to see it. Every single day when you look at the markets, you see the same charts and the same access of information as institutional and proprietary traders. And that's important to note that it hasn't always been this way. Up until about 2001, when the internet really started to emerge with this online trading business, and when the British pound became it used to be called the cable, because they actually had to dig up the ground and run a cable to your office to trade the pound. That's why it's nicknamed the cable. Today you have access to the same information as every other trader, and that's very empowering. So what we're going to talk about today is how you could use some information that you may not have heard out there before. This is going to be a very special and unique presentation, and the reason you may not have heard about it is because it works. So what we're going to talk about, the topic of today's call, is how to find where retail traders place their stop losses using order flow, and how to in turn make money with those stop losses. So as stop losses are hit, you'll be profiting rather than being stopped out. That's in turn our specialty. That's what TRADEPRO Academy does. It could almost be called Stop Loss Pro, because that's our edge. That's how we analyze the market. So let me ask you guys this question, and I would encourage everyone that has a moment that could type to answer this. What moves markets? Love to ask you guys this. What is the reason that a market moves or makes any kind of progress? Steven is here, one of our trade pros, one of our coveted trade pro members here. Say, hey, Steven. Almost feels like our morning live trading room. I'm talking to Steven again. That's correct. Supply and demand, says Bruce. People, says David. That's a maybe. Yeah, people is a good one. Supply and demand. Well, I'm going to let you guys think this one through. So I'm going to present it to you, and then at the end, I'll give you the answer. But it really is only one thing. There's only one single thing that's responsible for moving markets, and every other thing is a subset of this one thing. And I'll take you through, and then by the end of it, you'll know the answer. I think you guys already kind of got a feel for it too. All right, let me tell you my story. I'm going to turn the webcam on very quickly. I find it's interesting when somebody tells their story. Actually, can I? Renee, have you given me the ability to put my webcam on? Or are you telling me I shouldn't? I
I
had the
think
hair.
you should be able to.
Okay. I had the hair and makeup team come in and help me out. So I'm very presentable today. I don't see it. That's okay. That's fine. I'll tell you guys a little bit about my story. I started trading myself in 2001, and my dad sort of inspired me to get started. I asked him one day for allowance, and we immigrated from Bulgaria, so from Eastern Europe. He didn't really have much money. He was at home back in Bulgaria. He had pretty much the equivalent of a master's in his profession. But I asked him, early on, like, hey, what are we going to do? How are we going to make money? I was always interested in being wealthy, and working for myself, more importantly. He told me, I can't really give you money because I don't have it, but I can teach you about a way to make money. And so I was interested. So he got me started trading Forex. Currencies was my start in this business. So I was trading the pair gold versus USD, XAU USD. Many of you may know that. And I had a good time with it. He gave me about $10,000 at the time as a teenager. It's a lot of money, and he helped me fund the account. I put some of it in, but he pretty much gave me most of it. I took that 10, made it to about 160,000 very quickly. As you can imagine, as a trader, that's a lot of money. But really, I wasn't trading right. I was getting away with trading like an amateur because the markets were so easy to profit from. And I oftentimes say this quote, don't confuse bulls for brains. When it's a nice up market and you can buy just about everything and it goes up, that doesn't mint you a trader. When you become a trader is when the market crashes and you're still green and making more money than ever. So in 2009, when markets were collapsing and I was doing really well, I wasn't invited to any parties because everyone's having a pity party about their portfolio, and I was having the best ride of my life. But anyways, after when gold crashed, it hit about $1,030 an ounce. It dropped. I lost everything, the entire 160 down to nothing. So I saw it evaporate, and I knew that what I was doing, I kind of lucked my way into success. So I then went to school to take financial planning. I learned nothing about trading in my financial planning days whatsoever. Coming out of school, I was lucky enough to get an internship job as a trader at one of the big banks here in Canada. It's called Scotiabank. And I was on the trading desk for a couple of years there, and I got to experience a lot of things. I'll tell you guys one thing that really stuck with me, and it's not the most positive thought, but it's really what propelled me to be here today. I remember speaking to one gentleman on the phone when the market crashed, and he lost everything, his entire account balance. And I remember these words like they're just happening right now when I go back to that mindset. He literally said, I lost everything. How am I going to tell my wife? We had a lifestyle, a certain expectation. I have kids' college to pay for. I lost it all. And, at that point, I just thought about it, and it got really dark because he said some things on the phone that I had to report. So, not to give you too many details, but police had to be called. Things got involved because some of the words he said, you don't want to hear that from another human being. And it was a really dark time in his life and mine. So I said, you know what? I was writing a blog at the time. Naively, it was called gettingmarketmoney.com. I own that domain. It's fine. I still have the business cards to this day. And I was advising everybody at the time, at least take some profit. We've had a really good run, just get paid. And unfortunately, not many people did that. So it was then and there I decided for the rest of my life, all I want to do is trade personally. I want to be self-dependent. I want to have a lifestyle that's based on freedom, that I could create my own wealth on my own terms, and I want to help others do the same. I've been at it since 2012. That's when I founded TRADEPRO Academy. So that's one heck of an introduction. Let's get into the content. I should just use that for my book intro. But all you need to know about me is I've traded a lot. I've traded Forex, I've traded commodities. I now trade predominantly futures. I've done a lot of advanced option strategies. I've ran an option fund at one point. I've taught thousands of advisors around the country how to position investments to their clients. I've been in the industry for a long time. This is, in fact, all I'm good at doing. If I walk, I'll stumble over my own footsteps, but I know how to trade. So what I want to share with you today, what you're going to learn is you're going to find out where stop losses are in any market. So if you're a currency trader, commodities trader, futures trader, anything trader, you're going to learn how to find where stop losses are placed because this works in any market. All right, and I'm also going to tell you how to make money as these stops are being run. So what a stop loss is and why money is made when these stops are actually being hit. So what I'm going to tell you first is the retail trader mindset. So here's how the retail trader trades. Keep in mind, I've seen this. I've been a retail trader. In fact, I still am a retail trader, but you're not professional unless you work for an institution. That's the classification of it. So what ends up happening is your typical trader mindset on retail is this. They'll see a dip and they'll say it's too early. It's too risky to buy here on this dip. All right. And then they'll see it pop back up and they'll say, oh, darn it, I missed this opportunity. I'll buy it on the next pullback. And when we're talking about your average retail trader, we're talking about the average educated retail trader. 90% of the rest of them that haven't spent time to educate and develop themselves would not even buy it here. They'll continue to buy on the way down until it goes bankrupt. But they'll say, you know what, I'll get it on a dip. You know, the next pullback, I'll get a chance to jump in. And they see it, they say, great, I got my dip, I'm buying my shares, I'm going long. And then it goes up and they say, woohoo, I'm a professional trader, I'm gonna buy more, I'm gonna become a millionaire, this thing can't go down. And before you know it, all your retail traders are piled up on the same side of that one trade. They're all long. They're knee deep in long shares, whatever that market is. Well, let's look at the flip side to that, to an institutional trader or somebody who's doing it professionally, whose job it is solely to trade. Here's how they see it. They would have already found reasons to be long. And I say this a lot in our trading room. By the way, we run a daily trading room Monday to Friday, 9 to 11 a.m. Eastern. We show all of our live trades. We work with our traders one-on-one in there as well. We have people contributing about oil, NASDAQ, S&P. We have a great environment. One of the things I often tell those traders is when you look for a trade when it's the least risky, when you look for a trade where you almost say this one is, there's no risk. Everything's lining up. I got moving averages. I got RSIs, volumes increasing. It's at a Fibonacci support. My brother's cousin's uncle thinks it's a good buy. And you say there's absolutely no risk in this trade. What do I usually tell those people? I say that's the riskiest trade. The riskiest trade is the one where there is no risk. When you take a job like trading and you try to make it risk-free, you're gonna run into a lot of problems. When you're getting in, it has to feel risky because there's gonna be a return. Wherever there's the least amount of risk is the highest probability that you're actually gonna lose. So what the retail trader looks for is a riskless situation, whereas a professional trader would already be long and actually adding at the level where the retail trader is just starting to get excited. They're saying the next dip I'll buy. Institutional traders or professional money is already long. They already have a position staked out. And then what does the institutional trader think on the next dip? They say, you know what, this is now starting to get risky. The amateurs are starting to buy. The retail traders are starting to move in. What does a professional trader know? They say when retail money starts to jump in, what does that mean? There's buyers. Buyers start to get created. And what's the significance of a buyer? As somebody who's already long down here, you have somebody to sell it to. Remember, if you have a massive position, we're not talking 1 to 2 options contracts or 1 to 2 futures. We're talking 50, 100, 1,000 lots. You need a buyer to sell it to. So when the retail crowd gets excited, institutional is actually already selling to them. All right, and they're saying, hey, we're going to sell to take some profit, where the retail traders are still ready to get long. All right, and then what ends up happening is retail buying comes in and they say, guess what, I'm going to buy more. Keep buying the dips, right? What a beautiful trend channel. This support's hit 10 times, I want to get long. More. It'll go up. Institutional here says it's time to start selling rallies. So what you're getting here is the accumulation on the downside of retail buyers while institutional traders are getting out. They're using this retail buying panic, euphoria, and mania as an opportunity to get a nice price to get out on their shares. At the same time, what's happening here and here and here and on any dip? So if you actually draw a support line, what have we actually created? What have we created? What we've created is a lot of buying. Let me ask you guys this. If you know that out of 100% of traders, 90% of them are already long or have already bought, if you had that information, it's not available. There's ways that you can guess on it. But let me ask you guys this question. If you know that out of 100% of traders, 90% of them have bought, is that something that you want to get long into, or is that something you want to sell? What kind of, think about it, 90% of people are already going or believe it's going to go to the upside. Is this an uptrend or a downtrend? Well, here's the situation. If you have 90%, most people will say it's going to go up. The market's going to go up because that's what people are doing. However, think about this. If 90% have already invested, who's going to be the next dollar to make the price go up? Who's going to continue to buy this thing? Who's going to be the 10% that comes in? because that's all that's left. And as a buyer, what do you have to protect yourself? Let's say you're long a stock, you're long a future, you're long Forex. What do you have as a buyer that actually allows you to protect yourself in case you're wrong? Anybody want to take a shot at this? Stop loss, exactly. You have stop losses below. Well, look at this. If 90% is long, you don't actually have buyers. In order for a buyer to get out, they have to sell. So a current trader who's already long is not a buyer. They're actually a seller waiting to happen. So you know it's coming, you know the stops are coming down, and that's where retail traders finally get wiped out, where institutional traders are no longer long. They use these rallies to get out at the same time that retail was buying. So the whole dynamic of finding stop losses is actually analyzing the market from a point of being a professional trader, being institutional. Think of it as having not a $5,000 account, think of having a $500 million account. And then ask yourself, would I still be buying here? Because I'll tell you one thing I've learned from being in this business for a really long time is this. It's very easy to accumulate a long position. It's very easy to accumulate a massive long. What do you need to get out of your massive long? I had a friend one time telling me, George, I'm making a lot of money in Bitcoin. And I said, how much do you own of it? He said, well, all of it. I haven't sold any. I'm like, you're not making anything. Sell it first and then celebrate. So the point of that whole story is this. You could be a buyer, that's great. You could be long, but at some point your sell stop's going to get hit. As more buyers accumulate, you don't have bullish sentiment, you have bearish liquidity. And we'll investigate this concept. And you say, oh, my stop losses got hit again. Have you ever noticed sometimes, and I mean, this has happened to me as well, you get in here, you get long price rallies, comes back down, you set your stop here, it hits your stop, you get out of your long and it bounces back up, right? Who's that happened to? Be honest. Has that ever happened to you as a trader? This happened to me. I look like this guy. I'm like, oh, what am I doing? But interestingly enough, those levels provide tradable opportunities, and that has to happen. That doesn't happen by fluke. Your broker's not hunting your stop. That happens by design. Now, let me explain it to you. Let's flip the market on its head. After a strong rally, what do we have? We have a lot of long positions, a lot of buyers that have bought. What does a buyer have to do to get out of the market? They have to do what? They have to sell. So flip the market on its head, and if you just start to view your levels and your trading strategy from this angle, I almost guarantee you're going to see a new way. You're going to see the light. This one little tip. Look at it as the more buying that's going on, the more sell stops that are accumulating to the downside. The more sellers that are actually getting in, the more accumulation of buy stops we have to the upside. And in the market, we call this concept liquidity. It's liquidity. Oftentimes, and I'll show you guys right now, I'll pull up the ladder on my account. Here's a ladder. This basically shows you buying on the right side, selling on the left side. And one of the concepts here is, let's just do a quick analysis. Where's the inventory at the moment? You could see you got a couple 300 contracts offering to sell the S&P between 62.75 and 3 even. And to the downside, you got 390 to about 59. The majority of your current positions are waiting to transact at 62.75 to 63. Typically, the retail trader mindset says there's more selling to the upside, right? Watch that level as it trades. There's more selling up here. There's more liquidity. So that should push the prices lower, right? If there's more sellers. Well, that's actually wrong. That's the exact opposite way to look at trading. I once told one of our traders, if you could give me 100% losing streak, I'll pay you $1 million a year to provide me constantly losing trades. I'll just flip your buy button to sell button and we'll both be rich. All right. So the actual market dynamic and the way it operates is the market moves to and through liquidity. So one of the most important things you need to start doing yesterday is start to analyze order flow and start to look at level 2 analytics, looking at the depth of the market. Where are the buyers? Where are the sellers? Because the market doesn't move based on fundamentals. If the market moved on fundamentals, what would it look like? It would look like this. Why would there only be 4 changes? That would be a 1-year chart because it's Q1 earnings, Q2 earnings, Q3 earnings, and Q4 earnings. That's the only times it would move, when there's new information to be divulged or to be adjusted. The market does not move on fundamentals. The market moves on positions by traders that are stuck. And to answer your question, why does the market move? What causes a price to go up or down? Stop losses. Why? Because stop losses are orders of liquidity, and markets move to and through liquidity. Foundational concept. If you ever join a proprietary trading firm, this is what you would learn on the first day. One of the very first and most simple basic instructions. And I could probably tell you 90% of traders don't understand that yet. But you're privy to it now. So what you need to do is start looking at this. Look at these 62, 7, 5s, and 3s. Look how quickly we cleared them out. Why is that? Because we had a lot of inventory sitting there. So the market shrugged it off and then popped through and took out the liquidity. That was a buyable trade. If you went in and got the 61 on the S&P on the pullback, I should have traded. I just wasn't signed into the live account. The 61 that pulled back to, and it went up to the 64 where liquidity is, that's 3 points on the S&P 500s. It's $50 a point per single contract. It costs just $500 of margin to have one contract. So you just made $150 on $500 in 12 seconds using this exact same principle. So how does that help you find stops? Well, let's talk about that. Let me go back on the presentation. You guys are a very quiet group. You should come over to my office and get some caffeine, get you guys fired up again. If you have any questions, by the way, as I go along, I'm not the type of guy to wait to the end. Let me know and I'll answer them for you in real time. All right, so I'm gonna answer one more question for you. How do you actually find stop losses? It's not hard. It's not something as traders, we tend to overcomplicate things. I'm trained as a neuro-linguistic programming practitioner, master success coach, and clinical hypnotherapist. So I'm a trader, but I understand psychology better than anything else, or just as good as everything else. Why do we think that the simplest solution is not the right one? It's because we don't believe in ourselves. All right, and I'll give you guys a little exercise. If you stand up, you close your eyes, and you tell yourself, I believe I deserve to be a successful trader. Just get up and try it if you want right now. Say that. Notice which way your body leans. If you lean forward, that's actually something that's in line with how you've programmed your subconscious mind. If you lean backwards, no matter what system you buy, strategy, what package, coaching, mentor, guru, robot that you buy, you're not going to do it because you don't believe you're going to do it. If you don't believe you're going to do it, your subconscious mind will self-sabotage you. So don't think that the simple solution is not the right one. Just believe that you're capable of having the answers, because I believe that you are. And if you're not, I believe I could teach you to do it. Yes, absolutely, Mike. They are not real, but the depth of market shows you inventory. So the price ladder is intent to actually trade through that liquidity. The real volume that's occurred is what's actually traded. So you're in fact in real time comparing what is trading compared to what is intended to trade. However, on the depth of market, if you see a large order, despite the fact that it hasn't been traded, the market notices it. That's still liquidity waiting to be provided. And that's why it acts like a magnet. Does that make sense, Mike? Smith, spoofing actually helps you understand that. So what a spoof would do, and you could catch that in real time if you're actually spoofing these futures. Spoofing used to be really terrible in the S&P 500 futures a couple of years ago. They've actually introduced new laws and rules. Spoofing is not as predominant as it once was, but the spoof would essentially be the same thing. So what they would do is they would put 700 lots up here to look like they want to sell a big amount. Retail traders get scared of it. The market goes down a couple of ticks. They pull those lots and they actually end up buying it in order for the price to pop. So they're just giving themselves a better entry by trying to scare the market. But Smith, what happened in that situation? Because they still put a massive inventory there, the market might go down a couple of ticks, but they're actually the ones buying. So once again, that inventory is still indicative of the direction that it wants to move in. So it's still a magnet. It's interesting stuff. Oh, I know that, Smith. I know there's guys trading that have better seats than us. We can't try to measure up with them. We could just use their information to give ourselves an edge. I'll tell you something, in order to really spoof and to work the markets behind the scenes, if you know what I'm saying, it takes a lot of contracts, a lot of inventory. That actually helps us determine as smaller traders where to go. Before somebody trades 300-400 lots, I'm going to get my 10 in there and get paid. That's the idea behind it. So that kind of liquidity actually helps. Mike, ask. I'd love to help you. Let's go in here and I'll show you how to find the retail stops. Common misconception among retail traders. Actually, let me ask you guys this. There's a support level right here on oil, 57.50. It's touched it once, twice, 3 times, 4 times, 5 times, 6 times. Is this a good support? Yes or no? You guys answer me. Time to ask me some, time to ask you some questions. Why not, Mike? Why don't you think it's a good support? Well, here's the real answer. Let me ask you another question, because I like to ask questions. If one asset has hit support 3 times and another asset has hit it 6 times, which asset is the one that has the stronger likelihood of going up? Asset number 1 or 2? No, you're not allowed to answer, Victoria. We got a few people in the office. One of our junior trader here, you're obviously going to get this wrong. So it's too advanced for you. Michelle says 2. Why is that, Michelle? Let's dig into this. This is a safe environment, guys. I try to help you guys, and I don't put anyone under the bus, say, no, that's wrong, Michelle, it's terrible. But I do want to jump into a little bit. Some people are saying 1, some people are saying 2. That's interesting. So here's why most people would think 2 is the right answer, because they say it's hit it more times, therefore it's become stronger. More repetition means it's a stronger pattern. Actually, it's the inverse. More repetition means it's become more obvious, which means there's been longer opportunity for more traders to buy. And when more traders buy, what waits right below there? Sell stops, stop losses. Because remember, the more traders that are long, the more stop losses there is to the downside. All right, I hope that makes sense so far. Now, here's where it gets really interesting. There's stop losses below. So at some point, when it looks the juiciest for the uneducated trader as a long opportunity, that's your highest opportunity for a short sale. And look what happens. So you start to see into the candle. So here's one thing I wanted to show you guys. Many traders look at these bar charts and they say, hey, these candles are very important. In 2007 and 8, the candle chart was the best thing that we had going, best thing since sliced spread. In 2017, 2018 now, you have to actually look inside of that candle. How is that candle formed? It's one thing to look at a candle and say, hey, look, this thing looks great. It's another thing to see how did it get there. Because once a candle prints, the important part is how was it formed, not what does it actually look like. And this is called a footprint chart. And if you guys haven't had a chance to explore these yet, this might be the best takeaway that you've had all day, is look into using footprints into your trading. These things are phenomenal. We teach you in our course how to use this like a professional trader. If the setup that we use, if you went down to any proprietary trading firm, institutional firm, if you sit down at Goldman Sachs, if you sit down at any European prop desk, they'll use the exact same software and be looking at the market the exact same way. This is actually going to be white labeled for a few proprietary firms in 2018. So anywho, point I'm trying to make is this. On inside the candles, what you're starting to see is the accumulation of sellers starting to move in at the tops. You're seeing volume start to get pressed lower. And I don't have time to explain all this, but all you're seeing is high volume right at the lows, just building up. And you know, sell imbalances are starting to press. This means aggressive selling is moving into the market. You could just see it getting sandwiched in. These buyers here are just hanging on to hope at this point. And you know, below 55, you got sell stops. So a good trade here would be on a rotation up to 63, right where the point of control, VWAP, and sell imbalances had formed, is to get in there and hit a short. And what you're risking is about 10 cents to the upside, even less, 9 cents or so. My stops on the oil are 9 cent stops, 18 cent take profits. All right. What you're risking to the upside, you could more than make to the downside. It's worth a shot to try to ride some stops. And in fact, I did. That's exactly what I did. You can see this is a live trade that I've done. I shorted it at these 50s here, and I covered it back down to 57.23. This entire move lower, These are the same people that thought 6 bounces to support was strong. They got long, just getting their stops literally puked out of the market. They're puking. That's the term. It's not very, it's graphic, but I didn't make it up. I'm not responsible for it. It's stop loss is just getting squeezed out of the marketplace. And this is what I'm saying. Why did it go down? There were a lot of stops planted below because everyone thought it was going up. When everyone thinks one thing is happening, then the opposite happens. And that's where your liquidity lies. The liquidity is always the opposite of where traders think the market's going. Because if you're long, let's just go with this dynamic a little bit. If you're long, one trader might have a target here, one might have a here, one might have a here. So you have all these different orders up, they're scattered, but everybody is going to puke below. So we're going to go to the level where everybody's order is. This is the concept of liquidity, and the market goes to and through liquidity. All right, this sounds simple, but believe me, when you go to implement it, very few people use this type of analysis, very few. And I'll tell you another thing, some of you might be thinking, well, you know what, George, this is great. I'm happy that it works for you. I'm a swing trader. That's like saying I'm writing a book and I ask you, well, what are your chapters going to be about? I don't know. I'm just writing a book. At the end of the day, a good swing trader has to work hard to become a good day trader. A good day trader has already got what it takes to become a really good swing trader, because where do you execute a trade? You might be looking at a daily chart, but when you get filled with a time ticker down to the nanosecond. So therefore, even though you're looking at it on a swing trade basis, your execution is still intraday. You could never execute a swing trade. It's all just a day trade that you're getting into at the end of the day with the intent of holding it for longer. So becoming a good day trader helps you clean your entries up and become an even better swing trader. The beauty of that is, as a day trader, educating yourself to be a day trader allows you to pick low risk entries, which means you can put on more size on your swing trades, put your capital balance to work more efficiently. All right, so there's the stops. There's one example. I'll show you another one. Here's kind of the candle chart of how that shook out. Another indication this thing was going to break was the fact you saw a pile of selling delta on here. You guys see that? That pile of sell delta was also strong indication. And I mean, those concepts are a little abstract for the presentation. Any questions so far? Support and resistance are only one indication. One indication of what, Mike? Let me tell you this. Everything, and I told one of our students that's in for the week, everything on an entire trading, anything that you could think of, your trading indicators, your robots, all your proprietary mumbo jumbo that people code and try to sell you, it comes down to 4 pieces of information. How many buyers there are and at what price, how many sellers and at what price. Nothing in the market comes from anything other than this. So wouldn't it be worthwhile to learn how to read this, right? I don't want a messenger. I want to be my own messenger. I want to look at the raw data. All right, let's get back into this because I want to show you another example of some stops. Here's a few tips I have for you. I'm going to give you guys some tangible stuff. First of all, you want to find where retail stops are planted. Think like a retail trader and act the opposite way. First thing I got to tell you is stop using a time chart. The market doesn't care about time, only we do. Right? What's 5 minutes to a market? What does the market care more about? I told you liquidity. What is liquidity? It's a function of volume. So if you're following time charts, you're going to have one heck of a time trading successfully in 2018. Your chart has to show volume. So I'll give you guys some research to get started on. You need to look at a tick chart, a footprint chart, a reversal chart, even a point and figure chart works better. A 5-minute period where only one contract's traded, which will never happen, is not the same as a 5-minute period where 1 million contracts trade, which probably also doesn't happen very often. Those are 2 dramatic examples. But what I'm trying to get across is it's not the time, it's the price and the volume. That's what you're comparing. Time is irrelevant. If you're looking at a 15-minute, 30-minute, 1-hour chart, 1 day, 1 week, none of that means anything. You need to look at a chart that's based on volume or based on market rotation. If you don't know what market rotation is, I'll cover it very quick for you. Markets don't go vertically down. They go down, they rotate up. They go down, they rotate up. Every product rotates in different unison. There's different things to watch for, and there's different high opportunity, low risk entries when you know what to look at a rotation. Your time chart will look like this. It'll look very sloppy, where your rotation chart is clean in the exact same sequence. That's what it shows you. It eliminates chop and shows you the trend. So how to find the stops. If you ditch the time chart, it'll be much easier because you're going to see a clean trend. All right. Start reading order flow. Every professional trader is doing it, and you should too. I mean, I don't even need to expand that point, but I will. Order flow is how the buyers and sellers are transacting. For example, right now, if we're trading 57 on the SP 500, and one buyer wants to buy at 51, and the other buyer wants to buy at 56, you have to know that the 56 order is a lot more aggressive, right? This is a buyer who's closer to the market price. You have to know what that means and start to analyze it for your trading activity. How long do I day? I day trade 2 hours a day, and I go for a profit target, and I usually hit it within 2 hours. I don't work longer than 2 hours. I'll tell you why. In 2 hours of day trading, you're going to put in more mental effort than a 9-to-5 employee does in a whole week. That's the truth. You can't trade all day. It's not advisable. The longer you stay at the computer, yes, the markets might be good, but you start to stink personally. I mean, maybe physically too. You start perspiring and then sweating out some effort, but yeah, about 2 hours all it takes. The best 2 hours to day trade are 9:30 in the morning to 11:30 in the morning, because your US market opens at 9:30 and your London market closes at 11:30 Eastern. So this is what you call the US London overlap. It's the most opportunity, most amount of liquidity, most amount of volume. All right. Think in terms of liquidity. This is a big one here that I want to share with you guys as a takeaway. Don't think of this market. Let me give you guys something right now. And geez, I might get in trouble for this. Sorry, Renee. Nobody in this world could tell you where the market's going. Stop looking for that. Honestly, it bugs me when somebody says, tell me where the market's going. I don't know where it's going. That doesn't mean I won't be on board, right? If I ask you, where will you be in 10 years? And you say, I don't know, does that mean your life is not worth living? It's the same idea. So don't worry about where it's going. If you're looking at the right things, you're going to be on board. You're not going to miss the ship. Letting go of the need to be right. I say it in one sentence. Professional traders don't look to be right. They look to make money. Forget about being right. Be profitable. Because when you look to be profitable, you could make money even when you're wrong. The way I've set up my strategy, I could have a 40% win rate and still squeak out a small profit, mind you. It'll be break even more or less, but I could be wrong 60% of the time. Imagine being a surgeon and being wrong 60% of the time. Would you go for surgery? Not me. The problem is, as humans, we're conditioned to be right, and being right has absolutely no value as a trader, none whatsoever. What does carry value and weight is being profitable, being disciplined. So think in terms of liquidity. Don't look to know where the market's going. Just be part of it. And the way you could do that is analyze liquidity, look for shorter term profit targets. I always use this example in the trading room as well. Many traders say, hey, if I could make 2 points and make $100, if I make 10 points, I can make 500, right? Wrong. That's very wrong, because the more you stretch your target out, the less likely it is to reach there. Every time you take 2 points, every time you get a 10-point winner, you get a 2-point winner and a 5-point winner. But every time you get a 5-point winner, you don't get a 10-point winner. That significantly changes your percentages. So what I tell traders who want to aspire to do this professionally, I'll say, look for small moves regularly, and then the way you grow your net worth and income is width. You want to make 500 bucks a day, still make your 2 points, just hit a few more contracts. Increase trade size, not trade targets, because you're not in control of trade targets. It's not up to you, because we've given up the notion that we have to be right. Does that make sense? I hope I'm giving you guys some value. Victoria, am I giving them some value? All right. Victoria likes it. All right, so think in terms of liquidity. That's step number 3. So you want to find the stop. Stop using a time chart. It's not going to help you these days. If you look at it daily, it's nice for a trend. It's a beautiful piece of artwork. Hang it on your wall. Don't trade off it. Start reading order flow. That's very important. Know where buyers and sellers are, and think in terms of liquidity. Think, where are the stops going to be placed? I'll give you a quick little trick as a bonus tip. Number 4. Let's say, use sentiment indicators that are based on order flow, not price and time. Scratch out number 4. I'll give you a better number 4. Think about, if you're looking to buy a stock, think about being a seller and you're already short. And you ask yourself, if I'm short from 10 points above, am I getting out of this trade, or will I be a little bit more patient? And if you think from the opposite party's perspective, When you as a seller start deciding, you know what, I'd take some profit here, I'd start getting out, yeah, I'd cover some more. Now that's a transitional moment for you to start getting long, because sellers are buyers waiting to happen. So think of the opposite side of the move and ask yourself, would I still be holding? And if you'd still be holding a short, then this is the worst time to be buying. Why would you buy? Does that make sense? It's a little bit of a psychological trick. Do I read order prints, order flow across, or from below to left, upper right? I use I do both, depending on where the market price is at. So the footprints, do you use the footprints? The footprints actually are diagonal. They compare the bid to the offer, and they go from bottom left to top right. So that's what color codes them. But more importantly than the color code sequence is seeing how many trades are actually going through. There's a little bit of an experience curve to it to start really clicking with the footprint. And that's why many people don't use it, because you look at it and it looks confusing and you go look for the next thing that promises you $1 million. But it's a tool, right? So that's the thing I want to tell you. Ditch the time chart. Here's an example of the SP 500. This is a live trade that I kind of clipped. You see a little bit of short selling here, not a little bit, quite a bit. What's going on? Well, you see some buy imbalances show up, so some buyers are showing up here. You can see the shorts have started to slow down. You see this? It moves a little bit sideways. And now, remember the tip I gave you, number 4 from before. If you're short, would you still hold? I'd start buying back here as a short. We're just not breaking this low. And what happens? I actually did buy it. Look, I have 2 arrows. I bought it from 04 to 06. This is literally a 2-point move. I think it was on 8 contracts, and that small move made me a couple $100, half my profit target, or a third or a quarter, whatever you're going for that day. All right, so it's that simple. You don't have to overcomplicate things, because why does the market move? And there's a full profit target there at the 06 quarter. What moves the market? I asked you guys that a little bit earlier. Stop losses. All right. You could be the one getting your stop loss hit, or you could be the one who's taking other people's stops while you're making money. There's 2 ways to look at it. And I can tell you that if your stop loss is getting hit as soon as you get in, you're doing it too early. That's one of your first indications. If your stop loss, I'll give you guys a golden tip right here for free. I mean, it's not free, get your credit cards out. But if you have a stop and it's always getting hit, then you're getting in too early. So wherever your entry is, where's your usual stop? Forget about entering there. Put your entry where your stop would have been and put your stop below. It's not going to always get hit. Simple as that. Okay. Everything kind of just froze on me. I guess doesn't like what I'm saying. Here's the reality. To be a profitable trader, you have to be a professional trader. You got to treat this like a business. I know you don't want to hear that. Most people think they're going to quit their job, make $3 million from the comfort of their basement within 6 days. Good luck. We need people like that, unfortunately, for the market to function, but I don't want you to be a person like that. Here's what other basic premise I want to share with you. Most people's journey when they start trading, they think from day one it's going to start like this, and that's going to be account balance. The sad truth is it's going to take you a lot longer than you ever thought just to break even. Nobody could sell you a blue pill or red pill to make you better. You got to put in the time. But when you do break even, from the break even point to the target that you have daily is going to be much quicker than you ever thought possible. The only thing that's going to cap you on how much money you make is psychologically, how were you brought up? What are your values? What are your cultural background? What perception do you have of money? It's more psychological things at play. That's where you get capped. You only make what you think you're worth. All right. You have to think against retail mentality, and you have to trade with the trade pros. So let me give you guys a little bit of info about what we do, what we call our TRADEPRO Edge. You got 5 minutes, which is perfect. We pretty much provide institutional trader quality trading. This is information that proprietary firms do pay for in order to use and teach their traders. And it's not under the TRADEPRO name. I have to white label it, unfortunately, but they pay for that, and I'm okay with it. All right, so you learn things you didn't know existed because they work. That's kind of my little gimmicky tagline. We have a live daily trading room. It's all community-based. We support one another. We help one another. There's no judgmental thinking here. We all just want to see each other thrive. We trade daily futures. We do futures on anything. We trade futures on currencies, gold, oil. We do it on S&P, NASDAQ, Dow. We trade everything that you could imagine. Whatever moves, I'm on board. The Day Trader Pro package costs $99 a month, and you get access to our entire futures training program. You get our trade checklists, you get the course, you get the live trading room daily, and you do a Sunday webinar with me at 8 p.m. Eastern to talk about what's coming up in the week. So it's pretty much the ultimate sort of preparation package. This is more geared towards somebody that wants to day trade regularly, whereas the Swing Trader package, it's a weekly newsletter with a newsletter on trade ideas every single day and an update. All right, you get future swing trading course, daily market updates, email support, and more. And of course, the Elite Bundle is everything included, plus a once-a-month coaching session. You get Day Trader Pro and Swing Trader Pro. I'm sorry about this iLeo guy. He saves my vision. This blinking tiger's saving my eyes. Everyone thinks as a day trader, you're driving Ferraris, but you really have like seat back cushions and arthritis. That's, yeah, and carpal tunnel. That's the reality of the situation. There's a few successes from the trading room. I don't want to go in there and blow up people's situation, but I mean, there's a guy that made $27.50 shorting NASDAQ. All right, another guy did $400 on 2 contracts. This isn't somebody trading big positions. 2 contracts, $400. You need a $1,000 account to do that. All right. If you just show up on a daily basis, you'll see we have members doing this thing daily. It's the real deal. So yeah, I'm just tooting my own horn here. This feels good. Steven said that he lost a large majority of his trading account that became TRADEPRO Academy and then recovered. One guy says, I got to tell you, big aha moment. Thank you so much for all you do. What else? I'll just go through these. You guys can read them. We get a lot of feedback. I work very close with our team. I'll tell you guys this much. At TRADEPRO Academy, we call it the TRADEPRO family because we really are. If you guys just spend one day in our trading room, you'll understand why. We're a very tight-knit group. We help and support one another. And honestly, we're just there to profit. The profit, develop, and have some friends. When I first went trading full-time, doing it from my own home, it was challenging because I never had perspective. So the beauty of a community is I'm good at SP 500 futures. Victorio right beside me on the left is good to NASDAQ. If I could turn the camera on, I'd show you Victorio, but he's a real person. He's good at NASDAQ. We have Steven who's good at oil. We have new traders who are getting good at new products. So you're getting broad perspective. You're sampling the market almost. What's the name of the inter-candlestick indicator and the platform software? It's called Market Delta. Trevor is the guy who runs the company. Awesome guy, awesome platform. We have a special deal for Market Delta for our members. Yeah, it's called Market Delta. For subscribers, by the way, you get the full entire charting package, all my templates and indicators included for just a small subscription price. I'm not really charging per a la carte. All right, we also do some coaching support. You can see this is an email from me personally. It took time to draft this to the guy. I reviewed his trading. I told him what to work on. I showed him a risk management grid that I put together. I put a lot of time into helping our team, as do all of our other team members. So what I want to say is this, because my time's coming up. I have 20 seconds, Renee, and then you can kick me out. Nothing comes from doing nothing. Take action. I'd love to see you guys on board. The packages very quickly. Once again, Swing Trader is for somebody who doesn't want to trade full-time, just wants to do it while working another job. And then Day Trader Pro package is for day traders, and the Elite is entire bundle. So I hope to see you guys on there. We got a whole team ready to meet you. You're our next Trade Pro, and comes with a 14-day money-back guarantee, no questions asked. If you don't like what you're hearing, I don't want your money. I want you to be happy. That's my goal with this entire business. Remember why I started in 2012. I seen some dark stuff, and I vowed to never let that happen again to anyone else.